I'm assuming that I have student loans, auto loans, those lower interest rate consumer debts. Let's talk about now how I would manage that debt right now for me personally. The way that I would go about this situation is I would continue following 75, 15, 10. But instead of taking this 15 and putting this money into the stock market, I would take this money and use it to pay down those low interest rate debts except my mortgage. So I would use this money to more aggressively pay down my student loans, to more aggressively pay down my auto loan, and whatever other lower interest rate debts that I have. Now you might be wondering, but Jaspreet, you said earlier that the stock market has averaged 10% a year, but some of my lower interest rate debts, like my student loans, are 6 or 7 or 8%, and my car loan is 6 or 7%. Isn't that 10% return from the stock market higher than these lower interest rate debts that I have? Yes, but you got to remember that stock market return is an average. It's not a guaranteed return. And if I'm trying to figure out how do I build the most wealth, I want to go after the guaranteed returns first before I now start putting my money to grow into the markets and other places like that. And so what I would do in this situation is use this money to pay down my auto loans, to pay down my student loans, and get out of those expenses, because that's also going to give me a little bit more breathing room, because when I stop having that money leaving my account, well, now I have a lot more financial cushion, and I want to make sure that I have the financial breathing room and a little bit more of financial just space to do whatever the heck that I want. Which is why the first thing that I would do is pay those things off. Now, ideally, you're going to be more proactive with these things. That you're not going to go out and finance a car that you can't afford. You're going to go out and buy a car with cash, even if that means you don't get that BMW. Now you're driving a Toyota Corolla a little bit longer, and maybe the Toyota Corolla has some dents on it, but now you don't have to worry about those payments. And maybe that means you don't go into student loan debt. Maybe that means you change the way you go about college, you go to a cheaper college, or maybe that means you work through college. Whatever that might mean, ideally, you're going to change the way that you get these debts so you don't have to do this, because your investments are what's going to make you wealthy. And you want to start investing your money as soon as possible. But if you have a whole bunch of debts and expenses, I would want to get rid of those debts, those consumer debts, the things that are not making me any money, as fast as possible, because I know that 5, 6, 7, 8% that I'm paying to them, well, if I pay that off a year early, that's a guaranteed return, versus the 10% of the stock market isn't. This brings me to number 6 in the checklist, which, if you are a homeowner, is should I pay down my mortgage or should I invest my money? Or the alternative, should I buy a home or should I invest my money? So let's dive into that one. Now, if you remember what I said just a minute ago, when it comes time for me to use this money, the first thing I wanted to do myself is I want to pay down my student loans, I want to pay down my car loan. I did not talk about the mortgage. The mortgage is a little bit of a separate question because, well, mortgages can be a little bit tricky. Because while I don't consider my home an asset, I do understand that there can be equity built in that home by paying down that mortgage. And now sometimes some of you might have a much lower mortgage rate on your home. And this is where the question can be a little bit more different. And so now if I was answering this question for myself of should I pay down my mortgage or should I invest, the first thing I'm going to ask is, what is the interest rate on my mortgage? If my mortgage is sub 5%, it's going to be a different answer than if my mortgage is above 5%. Because if it's sub 5%, well, now I have a better likelihood of investing that money in the stock market or something and beating that return. And even if I didn't put that money in the stock market, well, I could put this cash into a high interest savings account and I can generate 4.5% to 5% a year in interest from a high interest savings account and use that money to pay this down if I have a 3.5% mortgage. So that's the first question that I would ask. Second question that I would ask myself is, what is my risk tolerance? Am I somebody who wants to just live financially free and just be comfortable, or am I somebody that wants to live a little bit bigger? Now for me, I have a little bit of a higher risk tolerance. I don't have the highest risk tolerance, but I have a little bit of a higher risk tolerance and I have bigger financial goals. So for me, because I have the higher financial goals, I know that I don't just want to be comfortable. I want to have the ability to build more extreme levels of wealth. I'm going to have to take different types of risks and I have to do different things with my money, which is why for me, especially if my mortgage is under 5%, I'm going to be more aggressive with my investments as opposed to just paying down my mortgage. Now, if my mortgage is 6, 7, 8%, now it's a little bit of a different question, because now maybe I'm going to pay down my mortgage a little bit more aggressively while also investing my money. I want to be investing my money, whether it's in my own business, whether it's in stocks, whether it's in real estate. I want to be investing my money, but this is where now understanding, well, kind of where the mortgage is going to change how I play this game. If I have a 2.5% or 3.5% mortgage, I'm going to continue paying the mortgage and I'm going to be investing my money other places as fast as possible. Now, the other thing that I would like to talk about here is, for me, ideally, if this was an ideal world, I'm going to go out and buy a rental property before I go out and buy my own home. That's what I did. I became a real estate investor before I even thought about being a homeowner. But now, if I was in a situation today where home prices are extremely expensive and I'm trying to think about should I buy a home or should I go keep renting and investing my money, well, the key question that I would want to ask here is what is the more affordable option for me? Because I don't look at buying a home as this ability to build huge generational wealth and build my wealth, because I want to build my wealth from rental properties, I want to build my wealth from my stocks, and I want to build my wealth from businesses that I build or own. I don't want to build my wealth through paying down my home. I know that's what a lot of people like to talk about, but that's one of the worst ways to build wealth or build generational wealth. And if you don't believe me, ask any wealthy person how they became wealthy, and they'll tell you they became wealthy because they invested their money in stocks, or they became wealthy because they invested their money in real estate, or they became wealthy because they built a business or invested in a business or something along those lines. They don't say that they became wealthy because they paid down their home. So I'm not saying being a homeowner is bad, just understanding how that plays a part in your investment portfolio. And this is where now, if I'm thinking about that home buying question, it's not really should I buy a home or should I rent a home, it's what's going to give me the ability to continue investing my money into the real things that's going to make me wealthy. Stocks, real estate, my own business, or other businesses. What's going to give me the ability to do that? If I can own a home and I can keep doing that, fine. If I can't, then I'll keep renting. The key is to be able to live wherever you can afford. That way you have the money to buy the assets that will continue paying you, that will continue making you wealthy, instead of just stretching so thin just to own a home. And the funny thing is, well, I used to be a licensed realtor. I still am, but I don't work as a realtor. But when I used to work as a realtor, every sales training talks about how now when you're talking to a buyer, what are you saying? You're telling them that they're buying this big investment, the biggest purchase of their life, the biggest investment of their life. And when you sell this home as an investment, it's much easier to get you to buy a little bit bigger, to buy a little bit nicer, because you think it's this nice investment. And then what it ends up being for the majority of people is a big money pit. You're just sucking money into this home and you no longer have money to invest because you just think that you're building wealth by building equity in your home. But if you really want to build wealth, it's not just by building equity in your home, it's by building equity in the stock market, rental properties, and through businesses that you own or invest in. That's where the real equity is that will make you wealthy, is not the home that you live in. Now sure, is that equity in your home that you live in good? Yeah, but I would rather have the equity in the stocks, rental properties, and the businesses than just the home that I live in. So understanding that question and making sure now that whatever I do is not going to sacrifice my ability to keep investing my money. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.